All right, everybody at Blue Sky. One of the things I wanted to do officially for this lab today is just kind of have a laid back conversation on what are options. And the reason, and I've been asked this a couple times today, and I was asked yesterday as well, why are we talking about options when we're futures traders? And really kind of a couple different things. I think one of my intentions here in this lab is to increase financial IQ in general on all asset classes, I think. But also options are tradable on absolutely every financial asset class out there. And over the last couple of weeks, I know quite a bit of you trade some options on your own accord, and so there were some questions over the course of the last couple weeks, and I was like, you know what? Let's just have a little bit of a conversation in one of these upcoming labs on basic options. What are they? What are the contracts? What are the option Greeks? How do we use them? Blas, what's up, buddy? It's good to see you as always. And so that's kind of the purpose of the conversation here today. Good to see you, my friend, as well. Now, from just an understanding perspective, has anybody ever traded options? Like, have you ever traded options before? Everybody, let me know. Everybody, let me know. So, Ron, you have. By the way, I love that name so much. Dell, never. Gabber, I know you do. Squared a little bit on the. Okay, awesome. Chris, you and me, buddy. I started with options as well. Is kind of where I got my start as well. And the reason being, this is back in the day, and back in the day, guys, we didn't have many micro contracts. We didn't have all those other vehicles that you guys have access to at your disposal. And when I mean back in the day, I mean like about 2 decades ago. And so when you first started trading, it really for me was stock, and I didn't have a lot of capital. I was 27, just out of law school, and I was just kind of getting going with life. I had $2,000 and I wanted to trade. I wanted to open up an account, wanted to start doing this, but I just didn't feel I could do stock because it's expensive. And so I kind of wanted to learn how to do options, even though I had zero clue what options were. Zero clue. When I made my first call option trade, I had zero clue what the contract was. I should never have done it, but I did it anyways because I just wanted to learn how to do something. And I felt like, okay, a contract, I don't have to put as much money into the contract. And in general, I can control the asset class and I don't have to own the asset class. And so that's kind of where my head was at the time. I can control, I don't have to own. And that's one of the things that I've realized in my career is that in trading, it's really not about ownership unless you're doing it for other reasons. For example, why do we own stock long term? Why do we own assets long term? Why do we own gold long term? Why do we own anything long term? What do you guys think? Why would you want to own something long term? Gains? Yeah. So can we just say growth? Right? Can we all just say growth? We want to capture growth over time. Okay. Did you guys see that the LA Lakers just got sold? Did you guys see that? And they got sold for $10 billion. And everybody's geeking out on that. Think about that. LA Lakers, biggest sell of all time. Okay. $10 billion in NBA sports. Let me ask you a question. If the Bus family would have parked the exact same money in an SPY index fund over the exact same time frame, which one would have made more money, owning the LA Lakers or owning an index fund? Which one would have made more money? They owned it since like 1982. So like 43 years. It's the spider. They would have had more money on the SPY if they just would have owned that. And I'm willing to bet you can do that on like 98% of asset classes out there, quite frankly. We own things long term so that we can capture growth long term, right? That's reason number one. So if I bought a stock long term or I bought a call option long term, I could kind of achieve either one of those equations. Now, obviously, options have time clauses too, and we'll get into that here in a second. But the point is this: we don't just buy stock for growth. That's reason number one. We actually buy stock for three reasons. I want everybody to write these down. Reason number one is growth. Reason number two is dividend. If we own a stock, that stock, if they pay a dividend, will pay us that quarterly dividend every single quarter. And the third reason is because when you own something, and I want you to think about this in just ownership perspective. When you own a real estate property, when you own a business, when you own anything, can you monetize that asset class? When you own anything, is there a way to monetize the asset class, i.e. cash flow on it? Yes, of course there is. And so, for example, in real estate, we rent out things, right? That brings in cash flow. Well, in stock, we can do the same thing, guys. We can rent out our stock we own through the concept of the covered call. And so what I realized when I was a young trader is that if you weren't going to own something for the dividend, if you weren't going to own something because you want to do cash flow on it, and the only reason you wanted to own something was because in the short term you wanted to capture growth, it made more sense in my head to buy a call option than to buy the stock itself. And I'll get into that here in just 1 second. And so people trade options instead of stock, instead of the underlying commodity, instead of the currency, instead of the real estate property, instead of the business, instead of anything. You can trade options on everything, ladies and gentlemen, instead of owning the underlying asset class, because it would allow us to lower our cost, leverage our money, and be able to capture that same degree of growth. Now, options, the number one difference between stock and options is options expire, stocks don't. That's the number one difference. Options have a time clause, stock does not. And so options are contracts. Contracts are traded between buyers and sellers. The buyer has a right, the seller has an obligation. And so if you're a buyer of an option, you have a right, you have a contractual right. You have a right to buy the stock at a set price on or before a set date. That's the contract. You as the buyer have a right to own that, to buy that stock at two clauses: set price, set date. The set price, I want everybody to write this down. Set price equals strike price. And so where you see in the contract, where you see in the contract, you have the right to buy it at a specific price, that is otherwise known as the strike price. On or before a specific date, that is known as the expiration date. And so options have these two clauses, and everything that we choose, everything we decide, what option we buy, what option we sell, what strike price do we do it on, what expiration date do we do it on, is predicated based on the rules of your specific price and your specific date. And so once again, buyers have rights, sellers have obligations. If the buyer exercises their right, the seller has an obligation to deliver. The same thing happens in every other market, guys. If Blas has a property, and I wanted to buy that property from him, and let's say it was $100,000, and Blas says to me, "All right, Matt, you don't have to come up with all the money, but I want you to put $5,000 down, and that $5,000 down will give you a contract that allows you to buy my property at $100,000 over the next 6 months. And if any point over that next 6 months, I exercise my right to buy Blas's property, what does Blas have to do? Not a choice, not an if, not a what, when. What does he have to do if I exercise my right to buy his property? He has to sell it to me, right? Same thing happens in the financial markets, guys. If you exercise your right to buy the call, or exercise your right to buy the stock because you own a call option, the obligation is on the seller to deliver you the stock. And so that's kind of what the contract is. Now, there's a couple terms that you really need to understand. Term number one is strike price. That's the set price within the contract. Expiration date is the last date of the contract. That's when that contract is done, gone, finite, get out of here, value zero at the end of the contract. Term number three, underlying asset. Whenever you buy a call, the value of that call is predicated on whatever the contract you are buying it on. You buy a contract on Apple, it's based on Apple. Term number four is just the premium. The premium is what you receive if you're the seller of the option. It's what you pay if you are the buyer of the options. Now, the reason traders want to learn how to trade options is not solely because they want to focus on just trading options. I'm going to tell you, most option traders I know, and I do know a tremendous amount of option traders, they like trading a lot of different asset classes. I like trading options. Well, I love trading futures. I like trading Forex. I like doing a lot of things. Option traders like to trade a lot of different things, quite frankly. But the reason why they focus on options is because options give them the best combination for the ability to leverage their capital to bring in cash flow and offset risk in the stock market. Any trader who ever focuses on the stock market, any trader who has a retirement account needs to understand options, because it's the options market where you will go to cash flow the stock market. It's the options market where you will go to insure your asset classes in the market. And it's the options market that allows you the leverage necessary to be able to navigate with the big dogs in the options, in the stock market as well. Now, there are two basic types of options, okay? You have calls and you have puts. Calls are a contract that gives the buyer the right to buy the stock. Puts are a contract that gives the buyer of the contract the right to sell the stock. And so instead of buying a stock, traders buy call options. Instead of shorting the stock, traders buy put options. And so a call option will make money as the stock goes up. A put option will make money as the stock goes down. Now, because the way we trade options is usually a little bit more complicated than just buying options or selling options, I want you to understand how options make money, because you can buy, you can sell, you can do a lot of different things. When you buy a call option, well, think about it like this. Markets can only go three directions: up, down, sideways. Money exchanges hands in every single capacity of that up, down, and sideways rotation of the market. As the market goes up, call options make money. So if you're the buyer of that call option, you make money. If the market goes down or sideways, you lose money on the call side. You will, as the buyer, you will lose money if the market goes sideways or down. And it will do that because of time decay and volatility. We'll talk about that here in a second. The other side of the equation of the buy call is the sell call. And so if you buy a call option, you better be right. You better be assessing that stock going up, that commodity going up, that currency going up, because if it doesn't go up, it will decay in time, and that value will go to the seller of the option. We'll get into that here in a second, guys. Now, on the flip side, you can buy puts and you can sell puts. On the buy side, you got to be right. You got to have that stock go down, because if it doesn't, that money will start burning through time decay and volatility and direction. And so the one takeaway you have to have when you understand the options matrix, the P&L options matrix, is this: buyers better be right. Directional traders have to be right on direction. Cash flow traders, i.e. people who like to sell options, they don't necessarily have to be right, because they make money on the time decay. They make money on the cash flow. For example, yesterday, I did a zero DTE trade yesterday on Fed Day on a straddle in the market. And what I did, guys, and I'll just kind of take it to the options market here on the spider. What I did was, and you can't see the option now because it was yesterday, but what I did is I came to the options market and I said, okay, I'm going to buy a put deep out of the money. I'm going to buy a put option. Now, if I buy a put option at 585, okay, right here. And I'll explain this here in a second, the option chain here in a second if you don't understand what you're seeing yet. I'm going to buy this 585 put option, and I'm going to buy this 604 call option. And I'm going to pay 50 cents for the 585, and I'm going to pay 30 cents for the 604 call. Now, I did that because I was expecting the market to move yesterday on Fed Day. And I didn't get that movement yesterday. Market went up a little bit, market went down a little bit, market went up a little bit, market went down a little bit. But in general, it really didn't move the way I needed it to. And so if let me get my Epic pen out here so I can draw some stuff. And so if I bought, and I want you guys to see how this works. If I buy a call option and I buy a put option and it didn't move, where did that money go? I lost the money because the money didn't move. Where did the money go? Who got to keep that money? Who got to keep that 85 cents of combined premium yesterday? What do you guys think? I was the buyer. I bought a call and a put. The seller did. So the buyer had to be right. I was the buyer. I had to be right. Was I right? No, I was wrong. I was not right. I was wrong. I didn't get the move I was expecting to get. Well, did the seller have to be right for them to make money? No, they just needed me to be wrong. They don't have to be right. The market can go up and down and sideways. I can't be right. And so buyers have a lower probability of success in the options market than sellers do. And so if all you do in the options market is buy, going into those transactions, your probability is not as high because in 3 directions of the market, buyers only make money in 1. In 3 directions of the market, sellers make money in 2 directions. And so I often get asked a question, guys, then why do we buy at all? Because buyers can hit home runs. That's why. I could have turned that 50-cent contract into $1.50 in that day. Buyers can hit those home runs. And yes, we will limit those downside as well. There's no doubt about that. Get those dogs and pooping there, Big Rich. that is pretty funny, actually. I'm going to steal that one from you, Tip. Now, when you deal with the options pricing, options, and this is where it can be a little bit complicated, guys, because options, their value of the contract is only, it's driven from the value of an algorithm. It's not just supply and demand. A stock goes up because of supply and demand. The stock goes down because of supply and demand. The market, commodities, currencies, everything goes up and down based on supply and demand. Options they go up based on that as well. However, there's 5 variables in why an option goes up or down. Now, this is the algorithm that controls the value of every option in the marketplace. And the beautiful thing about this algorithm is you don't need to learn how to understand this at all. Who here is really good at math? Like really, really good at math? Okay, Jaja, you're kind of like me. Like, no. Who here is really good? Come on, somebody help me out. Who's really good at options? Not options, but just math. Be my guinea pig. Okay, Laura. Okay, I love that. All right. What is 2 plus 2, everybody? What is 2 plus 2? It's 4, right? It's 4. All right. Every one of you can be a stock trader. If you can do that, every one of you can be a stock trader, because that's kind of the math you got to figure out in the stock market is 2 plus 2. Same thing in futures, same thing in Forex. Any directional situation is really kind of just a simple 2 plus 2 mathematical equation. But in options, you don't. So what's 2 plus 2, everybody? Times 3. 2 plus 2 times 3. Two plus 2 times 3. That would be 12. What's 12 divided by 3.61578? You probably need a calculator for that one, right? That's trading options. That's the algorithm, right? I don't know the answer either. I just made up the numbers, Jaja. I don't know the answers either. The thing about it is you don't need to. That's my point. It's you look at this algorithm and it's like, oh my goodness, this is complicated. I just want to go buy a futures again, right? I just want to go trade the ES. I just want to go trade the NQ. Futures is easier. That's not the point. The point is you don't need to know this. What you need to know is, well, let me put it like this. How many of you guys have driven today in any capacity? You drove a car, truck today. Anybody has driven today? Okay, Bucky, you did? Bucky, do you know how to build a car engine? I don't. I personally do not. Okay, so you can a little bit? Okay. Now, did you think about building that car engine when you started that car, or did you just turn on the keys and just start driving? You probably just turn on the keys, right? That's what you got to do here, guys. Okay. You got to understand how it works, but you don't have to understand how to read this algorithm. What is in every algorithm, and I was not good at math. I had to bribe my Math 105 teacher in college just so I can pass. I was already accepted to law school, guys, and I hadn't graduated yet, which I needed to. I hadn't taken Math 105 because I was not good at math and I didn't want to take it. So I bribed my teacher. They gave me a C minus. It's a long story. It was fantastic. And I graduated, went to law school. But I know how to drive the car. And in the algorithm here, the only thing you need to really understand is the variables. And the variables are known as the option Greeks. The option Greeks are what drives the algorithm. And so there are 5 variables in the algorithm. You have delta, theta, vega, gamma, and rho. Delta stands for direction. So if the stock goes up, that call option makes money. It makes money based on delta. That put option, the stock goes down and you have a put option. Well, it's going down based on delta. Delta stands for direction. It helps us understand the directional nature of the reward to risk in an option trade. Theta stands for time decay. How much time are you going to be in the trade will help us understand how much time decay you're going to get. And so time decay is a risk to buyers. It's a benefit to sellers. Every aspect of options is the same as every aspect of the financial world, ladies and gentlemen. Money exchanges hands. Tip, that's a great question. Does rho come into play on long-term options only? I can't tell you the last time I concerned myself with rho on a short-term option trade. And when I mean like anything less than like 3 months. Like I have not concerned myself with rho. I haven't thought about rho. Rho, even on the longer term side of the equation, like on leaps, was not an issue up until like the last couple of years. And then if you are doing leaps, rho will have an impact, but even at that, it's so minimal that the other Greeks have such a bigger impact tip that it's going to be such a secondary part of the analysis. And so I would say in terms of kind of the importance of the Greeks to our understanding of trading options, delta, theta, and vega are chiefly important. Vega is going to impact your option trade quite a bit. Theta is going to impact it, and that's the guarantee of the market. Delta is something that is extremely sensitive. Gamma can be sensitive at the end of the option contract, but rho is just something I rarely actually care that much about, to be honest with you. And so, yeah, I'd have to go ahead and agree with you that rho only comes into play when you're doing some degree of leap. And leap is a long-term expiration play in the options market, guys. Anything longer than 8 months of time is considered a leap. It's just a time frame that people look at in the options market. The ones we're going to focus on for the most part as an option trader is delta, theta, and vega. Gamma is going to be sensitive, like when you're dealing with options at the last part of the contract. Rho, just not really part of it. And for anybody that does any type of like short-term trading in options, zero DTE, which we're going to talk about over the next couple weeks, but zero DTE or swing trading, I would say Rho just doesn't get any love. It's kind of the forgotten Greek of all the Greeks, quite frankly. And so once again, delta and theta are chiefly important because there's rules for the contract on both delta and theta. I'll get into that here in a second. Vega is volatility, and it's very important to understand where volatility is so that if volatility is really, really, really high, you don't want to necessarily be a buyer of an option because volatility is high. You want to sell that. And again, I'll explain that here in just a second. Now, let's get into kind of what makes up the premium. And so before we do this, let's go into TOS here and let's talk about the option chain. Now, how many of you, when you pull up an option chain, and we'll look at Delta Dog's option chain here, how many of you, when you pull up an option chain, this gets real confusing real fast? When you see all this data here. Who here gets confused by what you're seeing on the screen? And it's okay, that's why we're here, right, Aaron? Okay. Yeah, let's understand it. Let's understand it, because 95% of this stuff you see on the screen is not important to you in any capacity. Each contract is going to have the values associated to the contract listed. And so on every stock, I'm looking at Delta Dog here, a Data Dog. It's an AI play that I'm doing right now. Data Dog here, the first thing you got to understand about the option chain is every month, every stock, every commodity is going to have months listed on the option chain. Every one of these months or months contracts expire. And so this contract right here expires in 1 day. And so do you see where this says 1 right here? It says 1 day. This 1 is, there's 1 day left in the contract. 8 days, 14 days, 22 days, 29 days, 57 days, all the way up to 575 days. And so all these contracts here, this 130 contract right here, this expires in 575 days. Well, this same contract here, 130 contract here, expires in 1 day. And so the first thing we need to understand on the option chain, and that's where every option is listed, is the first thing is the expiration date. That's the first thing you need to select. And so if I was doing, like, say, for example, a trade where I was going to be in a trade 2 to 3 weeks, I'm going to go out more in time, and I'll explain that here in a second. So the first thing you have to select is you have to select the time frame that you're going to want to trade. Now, if I select the 57-day contract, that does not mean if I make one of these trades on this option chain that I need to be in the trade 57 days. That's not what it means. It just means the contract is available for 57 days. I don't need to hold it for 57 days. I can hold it for 1 day and sell it back to the market the next. I can buy it for 1 second, get out of the trade in 5 seconds from now. It's just the contract is available for 57 days. And so the first thing you need to select is the contract. Now, when you select the time frame in the contract, you'll see it drops down what's called the option chain. And let's limit the data so you can see this a little bit better. So every option chain, and brokers are going to have their unique way of displaying it, but every option chain is going to be a little bit similar. On the left-hand side is going to be where all the calls are listed. And so all these options on the left-hand side of the chain, these are all call options. Down the middle of the option chain is all the strike prices. And so strike, here's all your strike prices you can select. On the right-hand side of the option chain is where you're going to see puts listed. So calls are going to be listed on the left-hand side. Puts are going to be listed on the right-hand side. Down the middle is where all your strikes are. Now, this is Thinkorswim's option platform. It's a very popular one for people that trade options. And quite frankly, it's why I am with Thinkorswim, is because their options and how they trading options on TOS is just infinitely better than any other platform, in my opinion. But I also have bias there. I've been using them for a very long time. But this is how they display it. It's not that dissimilar to other option chains. These values all come from the market, obviously. Now, on the left-hand side, you can see some columns here. Here's your delta column. Here's your gamma column. Here's your theta column. And here's your vega column. And so what you're seeing in these numbers is just the option Greeks listed per strike price. And so it feels like there's a lot of information here, but every piece of that information is based on this strike price. And so all this line item here has to do with this 130 strike price. All this line item here has to do with that 110 strike price. And so it feels like a lot of data, but it's really, you're looking at different options and different strike prices, and you're going to select one of those. Now, when you do look at the bid and the ask, one thing you'll see here on the option chain is the bid and the ask. Now, the bid, these are contracts that are in the market. There's an offer to buy that contract for $550. The ask, there's an option, there's an offer to sell that contract for $565. Those are in the market. Now, obviously, as futures go, you got buyers, you got sellers, you got market makers. If I wanted to buy that contract right here, I would put it into the mid price at 560, and that's where the algorithm will fill the trade. That's a secondary conversation. But for now, I just want to explain that's what those numbers are. These are orders that are in the market to buy that option. Here's orders that are in the market to sell that option. The mid price is where you're going to get filled if you're making the trade. Meaning, are you going to be a little upside down in the trade typically when you get involved in an option? Yes or no? What do you guys think? Yes. It's kind of like you're trading currency. You're giving up a little bit of the spread. So the only reason I bring that up, guys, is if the spread is really wide, is that kind of telling us something? It is. It's telling us you shouldn't trade that option, is what it's telling you. We want tight spreads is what we want. Okay. So on the left-hand side, what's listed on the left-hand side here, guys? What are these? What are all these contracts right here? What's listed on the left-hand side of the chain? Calls or puts? Calls. And what's listed on the right-hand side? Calls or puts? Puts. Okay, good. Now, first thing we always select is the expiration date. That drops down the chain. Then we select the strike price we want to trade with, and that's all based on rules. Now, when you see the values of these options, okay, you got bid and the ask. This is the premium. This is the premium. Now, this premium is made up of those 5 components: delta, theta, vega, gamma, and rho. And so this premium is made up of all these Greeks in the algorithm. Now, this premium truly has 2 values to it. And by the way, most things have 2 values to it. And you can see it right here. Do you see this word? Intrinsic. This word extrinsic. Intrinsic, extrinsic. Now, you see where all this says 0, 0, 0, 0, 0, 0? Intrinsic. See these zeros? Intrinsic. Zeros. Now, on the flip side, extrinsic. Every strike price has extrinsic value. Once again, puts. Every strike price has extrinsic value. Not every strike price has intrinsic value, because there's 2 values associated to an option contract. Intrinsic value is the real value of the contract, the in the money portion of the contract. And to understand this, let's go back to me and Blas's real estate deal. Blas was going to sell me a $100,000 property. I paid him $5,000 for the contract to own the property at $100,000. I had 6 months. If that property goes from $80,000 down to, $100,000 in the next 6 months down to $80,000. Now, is that contract somebody, okay, figure out how much intrinsic value is in the contract. That $5,000. I paid Blas $5,000 to own a contract to give me a right to buy his property at $100,000. The value of the property goes to $80,000. How much value, i.e., real value, is in the contract? Zero. Okay, it went down to 80. I have a contract at 100. I can buy it at 100. There's no real value to that. Would I ever exercise my right to buy his property at 100,000 when the current value is 80,000? Or would I rather burn the 5,000 and just pay him 80,000? You do lose your deposit. Okay. Well, that's the benefit of real estate, right? But let's just keep it from the mathematical perspective. If you wouldn't theoretically exercise the contract, there's no value to it. Okay, exactly, Dale. You burn the 5, you pay the 80, and you keep the 15. Exactly. That means of the $5,000 contract, there's no value. There's nothing intrinsic. Intrinsic value is real. And so let's take it into the stock market. Just real quick. Let's go to Delta Dog here. Price is 130. Contract 130. Do you see how it says 4 cents of intrinsic value? Once again, right here. So 130 and 4 cents. 130, 4 cents intrinsic. There is 4 cents of real value in this 130 contract. Because again, always think about this from an exercise. If you exercise the contract, if I buy that contract at 130 and I exercise my right to buy the stock at 130, I'm only getting 4 cents of real value. Does that make sense, everybody? Intrinsic value is the real value of the contract. And so if I own the 140 contract and the current stock price is 130, there's no value to that intrinsic value. There's nothing real to that. It's all extrinsic value. And so understanding intrinsic versus extrinsic is very important, guys, not just for options, but in general in the financial world. Intrinsic value is the real value of something. Extrinsic value is the time and volatility value of something. And so when you talk about real value versus fake value, real value has real value at the end of the contract. Fake value, i.e. extrinsic value, time and volatility, that has no value at the end of the contract because there's no more time left in the contract. And when there's no more time left, there's no more anything. There's no more volatility. There's no more anything. And so that value goes to zero at the point of expiration. And so when you deal with intrinsic, I want you to think about this as, once again, the real value of the contract. If you're dealing with the stock priced at $50, well, that is considered the at-the-money contract. The at-the-money contract is the exact same price as the strike price you are trading itself. The in-the-money contracts are the ones with real value, real intrinsic value. Those contracts can be exercised. There's real value to them. Then you have out-of-the-money contracts, which will never get exercised because there is no value to them. Remember, contracts can get exercised at any point, but they will never get exercised if there's no value to them. And so intrinsic value is the in-the-money portion of the contract. It is the real value. If I own a stock, or if I have a stock at $100 and I buy the 105 call option, I would never exercise my right to buy the stock at 105 when the current stock is 100 and I can get a better deal in the stock market. But if the stock goes from 100 to 110, I could exercise my right at 105 because now the price is 110 and now there's $5 of intrinsic value in that contract. And so once again, you might make the trade by buying the $50 strike price with the expectation that the stock's going to go to 55, and now you have $5 of intrinsic value, that you have real value in the market. That's what intrinsic value is. It is the real value of an option contract. And to be able to determine the intrinsic value, you simply take the stock price minus the strike price. That's it. That's it. You take the stock price, you minus the strike price. And so let's go with, and you guys, I'm not going to let you see the intrinsic value. Let's go down to the deltas. All right, let's go with Amazon here. All right. So Amazon's trading at 212.52. If we buy the 230 call option, we own the right to buy the stock at 230. The stock currently is 212. How much intrinsic value is in that contract, the 230 contract? Right here. How much intrinsic value is in a 230 contract on the call side when the current price is 212? There's zero. Because if you take the stock price at 212 and you minus the 230 strike price, there's zero. It's a negative, right? Zero. Well, if I take this strike price at 200 and I take the 212.52 stock, 212.52 minus 200, well, what should my intrinsic value be? Exactly, Gabber. Exactly, Dell. It should be 1250. And so when you come back, there it is, 1252. That's all it is. And so intrinsic is the in the money portion of the contract. If a contract has intrinsic value, it is in the money. The contract can be exercised. You could legitimately make that decision to exercise the contract. You probably won't, but you could, because there's real value to it. Anything out of the money has zero intrinsic value because it's all made up of time decay. It's all made up of volatility. It's those two Greeks that make up the portion of the contract in and out of the money contract. It's out of the money. It doesn't have any intrinsic value. And so once again, you have these three types of contracts: in the money, at the money, out of the money, all based on intrinsic versus extrinsic value. And when you're dealing with intrinsic value, it's the in the money portion. When you deal with every other aspect of the option trade, that is out of the money. That is time decay. That's volatility. That's called extrinsic value. Extrinsic value is a decaying asset of time. And so when you look at the contract, guys, and are you guys having fun today, by the way? Are you learning a little bit about options? Awesome. Awesome. Now, in terms of the clause of the contract, okay, if you go back to the contract itself, there's two clauses. You have a time clause and you have a price clause. Okay. The time clause is based on a rule based on theta. Okay. A price clause is the clause based on delta. So theta and delta are the two most important Greeks for us because they help us understand how much time we should buy or sell and what price we should control that asset for. Now, I would say volatility is a very important Greek as well, but it's more of an understanding of what types of strategies you should focus on. It doesn't really help us select the contract. And so I want to spend a little bit of time getting to know theta and delta. Now, theta, I always talk about theta first when we're dealing with selecting the proper contract, because when you're dealing with theta, guys, you're dealing with the first contract. And remember, what we have to determine first is we have to determine the time clause in the contract. Well, when you buy an option, time works against you. When you sell an option, time works for you. For example, yesterday when I was in that trade, that when I bought the call and I bought the put and I took the L on that, was time working for me or was time working against me? What do you guys think? It was working against me. I had to be right in that day, because if I would have gotten today's pricing, I would have made more money. We got the move I was expecting yesterday today. Did that help me yesterday when I got it today? No, it just made me look at the market and be like, oh, okay, that's how you're going to be this today, huh? Uh-huh. You're going to give me my expected move 24 hours later. All right. Didn't really help me on the trade yesterday. Okay. And so when you're dealing with theta is that first thing you have to select. And as a directional trader, you have to be right in your time frame. And not only do you have to be right in your time frame, but if you're doing anything on like the swing or the position side, you got to be right fairly quick in the contract. And so when you deal with theta is a decaying asset of time. It tells us exactly how much is decaying out of that option chain every single day, day after day, regardless of a holiday, regardless of June 19th, or regardless of Christmas, or regardless of Thanksgiving, or regardless of July 4th, or regardless of New Year's, regardless of your birthday. It does not matter. It will decay every asset every day, day after day. But it doesn't decay at the same rate. And that's the kicker. Theta will not be noticeable in the time decay element when you're dealing with a lot of time in the contract, because there's a lot of time in the contract. And so if you have, for example, 4 months of time, theta decays at about 0.4%. And so if we go out in time, for example, and we go out 4 months, here's a 120-day contract. It's legitimately exactly 4 months of time. Now, if I'm right, we'll be decaying at about 0.4%. And so if you look at time, let's go to our option Greeks and let's deal with that, not Amazon. Let's deal with Amazon. And let's just do it the at the money strike here. Okay. So the 215 strike here, that's the strike price, $215. Now, if you look at theta here, it says $8. So it says 8 cents. Well, each contract controls 100 shares, 8 cents times it's $8. Okay. So, or 80 cents. So out of this contract right here, you would have to spend around $1,580 to control that $215 strike price. Of that $1,580, you would lose 80 cents tomorrow, and 80 cents the next day, and 80 cents the next day, and the next day, and the next day, and the next day. Now, if you look at the 1 day contract here, okay, 1 day, same strike price, 215. I was right, Gabber. Thank you for that. The same 215 strike price. Now, of that 76 cents, how much of that 76 cents is going to decay tomorrow? What percentage? So if I buy that option at 76 cents and the theta is 76, what percentage of the option chain is going to decay tomorrow? It's all of it. All of it. So if I bought that $215 call option that expires tomorrow, I better be right tomorrow, because it's decaying at 100% value. Whereas if I go all the way out in time and I say, nope, I'm going to buy 120 days of time, I'm only decaying at $8 against the $15.80 cost, which means I'm decaying at, what is $8 divided by $15.80? I'm decaying at 0.5% decaying rate. And so when you deal with options, guys, theta is something that it's not to be messed with. You got to respect theta. Theta is the time killer. It's the killer of all option trades, basically. And so if you're the buyer and you're going to hold 2-3 weeks, you can't just buy 2-3 weeks. You got to buy a month and a half. You got to buy 6 to 8 weeks, because if you just buy what you expect to hold, this is why buyers always lose money. How many of you amazing individuals have heard trading options is risky and it's like gambling? How many of you ever heard that? Okay, guys, it's said by degenerate gamblers who don't understand options. That's what it's said by. It's because when they think about an option, they think, oh, I'm going to make a trade over the next week. I'm going to buy a week of time. And even if they're right on direction, they get smoked by time volatility and gamma. They don't understand that the option is not just part of direction. There's other aspects of that option contract that is going to either increase their value or decrease. Now, tipped, I'll say that 0DTE is a little bit different, because it's a little bit different. There's no doubt about that. But if you're doing anything outside 0DTE, because you know damn well what's happening on 0DTE, those options are done that day. But the biggest problem I see is not traders trading 0DTE. That's a perfectly viable way of navigating the market. There's no doubt about that. The difficult is when buyers buy 2 to 3 weeks of time and then they get smoked, or they buy an option in front of a volatility event and they don't understand how volatility impacts the option, like an earnings report, for example. And they buy a call option, stock gaps up, but they still lose money. And they're like, how the hell am I losing money when the stock gapped up and I own a call option? Well, that's because you got killed by volatility crush out of earnings. And so it's really not the 0DTE that's the issue. But that is that's a very aggressive way of trading options. Obviously, we'll talk about that in a couple of weeks. But in general, it's when you're buying options over a 2-3 week time frame in swing trading mentalities, right? And those swing traders, like on Datadog, for example, you come back over to the chart on Datadog, D-Dog here. Man, that breakout's legit there, guys. The beautiful breakout. Trigger yesterday, continuation here today. That's a beautiful trigger. Well, an option trader might come and say, well, I'm going to buy 8 days of time. And that in that 8 days of time, if I get D-Dog to get up into 145, 160, we're gonna print money at that point. Well, maybe not, because over that 2 weeks, you're gonna get ripped based on theta. Every single day, you're gonna lose $17 out of a $200 trade. Every single day, you're losing 8.5% of the value of the entire call option every single day. You better be right every single day. Does that make sense, everybody? Whereas if you go out a little bit more time, you're literally minimizing the theta risk by half just by going out a little bit more time. And so it's not really an issue if you're 0DTE trading, because you know what you're doing there. It's really where I see the biggest problems on the theta side of the equation. It's when the swing traders who are holding 3, 5, 7 days, and those swing traders buy 3, 5, 7 days of time like they would on a 0DTE contract. Well, they get killed. They get absolutely killed in that. You can chart your Greeks, yes. Not like a candlestick chart, but you can overlay them. I haven't had a tremendous amount of value in terms of my personal understanding, but I could understand why somebody else would do that. Yeah, yes, there is you. Well, I think you're asking a different question, Tip. I didn't want to. Oh, Dell, 0DTE is 0 day options. 0 days till expiration is what it stands for. So 0 days till expiration. It is day traders. Day traders in the options market uses 0DTE. And it's I would say it's becoming really popular, but it's really exploded in popularity over the last few years. Like 0DTE was not a thing when I started trading, guys. It was not a thing. In fact, 0DTE was really, well, let's face it, only indexes had those, and only indexes did that once a month. And so if you wanted to zero DTE trading 10, 15, 20 years ago, you were really relegated to once or twice a month, and you were like doing it just on indexes, and it's just been a thing over the last few years. And Jaja, I think it's going to increase. I mean, these things are happening more and more, and the brokers are finding creative ways to get, people access to more and more. When I first started trading options, guys, strike prices were really limited to $2.50 spreads, even on like a $25 stock. It was ridiculous, absolutely ridiculous. Now they trade like every 50 cents, every quarter, every dollar. I mean, the options you have are just unlimited. Now, as time decay goes on, guys, what we just saw in the option chain is it starts to decay faster and faster and faster and faster up until the point of expiration, where that contract is worthless. That's how time decay works. And so when you deal with the options market from a standardized perspective, I'm not talking zero DTE here, I'm just talking standardized perspective. The buyers typically want to be in that 45 to 60 day time frame. Even if you're only holding a couple weeks, you do that because you don't want to mess with theta. You don't want to mess with theta. You don't want to mess with gamma. You want to get out a little bit more time. I might hold a week. I might hold 2 weeks, but I own 30 to 45 days of time. I might hold a month. I own 70 days of time. I hold 6 months. I own 9 months of time. I'm looking to hold a week. Once again, I'll hold 3, 4, 5 weeks of time. But I never really am doing anything here on the buy side of the equation unless it's zero DTE. And again, that's a completely different type of conversation. Now, you see this cash flow zone? This is where sellers live in the options market. They love the 30-day number. 30-day number is their cash flow zone. They love selling options with 30 days till expiration. Every single month, ring that cash register, bring in that cash flow, compound those gains, buy more stock. Cash flow systems live in the last 30 days, guys. Every cash flow system I've ever utilized, every one I've ever learned, every one I've ever taught, all starts with cash flowing in the 30 to 60 day time frame. You can do 7, 14, 30, 60, but they all start with this type of time frame. You're not really starting cash flow systems with months to go in the contract. You want to take advantage of time decay. And so, Gabber, we were talking about my brother and how he does like naked puts and covered calls and credit spreads and diagonal spreads and so on and so forth. He's always doing like a week left of time, 2 weeks left of time, 30 days left of time, always trying to time different expirations, constantly coming in, and those options just worthless, worthless, worthless. Now, my brother, who just does cash flow systems, guys, I do a lot of directional systems. He does a lot of cash flow systems. He will always have a much higher batting average than I will. Always. Theta is always designed to have a higher batting average than delta is. But cash flow can only make what they sell. Delta can make more than what they buy. Cash flow, you can only make what you sell. And so if I sold you an option today, I'm never going to make more than what I sold you that option for. I just need to liquidate it. Now, when you deal with that option contract, once again, the first thing we need to select is the expiration date. Once we select that, we're good to go. The second thing we need to figure out, guys, when we're doing an option trade is what strike price to trade that on. Remember, when we were dealing with the options market here, lots of expiration dates, lots of strike prices. And so if I was going to do a buy on Delta Dog, I call it Delta Dog, but Data Dog over the next, say, week, am I going to buy 8 days of time, 29 days of time, or 57 days of time? Which one, guys? If I'm looking to be in Data Dog for the next week, I did the 29 day, Aaron. That's exactly what I did. I did the next 29 days because I'm going to be in that trade probably a week. And so I didn't want to do the 8-day contract because that expires in that week. And if I only hold that contract for the time I expect to be in the trade, Theta is going to decay it down to zero, which means I need that stock to get on an Elon Musk rocket ship. And based on last night, I don't know if that's going to work out right now. And so I don't want to be perfect. And that's what you have to be if you trade an option contract in the exact same time you expect to be in the trade. You have to be perfect and then some. And so I'm going to go out a little bit more time. And if you're even more conservative and going out because you don't want to deal with any of that, that's perfectly fine. Just realize you're going to pay a little bit more premium because the more time you have, the more premium is in that contract. So once I've selected the expiration date, that's going to drop down the option chain. Now, options, calls on the left, puts on the right. I expect Datadog to go up. And so I am going to buy a call option. Now, which call option is based on delta? And this is going to vary based on strategy and technique. But in general, guys, what I would recommend is don't be radical on the option side of the equation. And what I mean by that is delta ranges from 0 to 1. 0 to 1. Because what delta does is it measures the magnitude of your option value to the magnitude of a $1 move in the stock. And so if the stock price moves from 130 and 4 cents to 131 and 4 cents, so it moves up $1. Well, every one of these option premiums will not go up $1. That's what the stock did. Stock moved $1. The option moves at the rate of delta. So what delta really does is it tells you the percentage that you're going to capture per that $1 move in the market. And so if you buy an option and it moves from 130 and 4 cents to 131 and 4 cents, and you own this 135 call option, you're capturing 37% of that move. You're capturing 54% of that move, 81% of that move, 2% of that move. Delta is telling you the percentage you're going to capture both on the return and the risk side of the equation, given that $1 move in the market itself. And so delta stands for direction. It measures the magnitude of a $1 movement in price, both up and down. The second thing delta does, and I think this is one of the most powerful things in all of trading, quite frankly, is it determines the exact mathematical probability of every strike price finishing in the money or out of the money at the point of expiration. Meaning every one of these contracts at the point of expiration in 29 days, this contract at 135 with the current stock price at 130, taking into account all variables in the Black-Scholes algorithm, says there's a 37% probability that that strike price will finish in the money, which means the options market, guys, is a probability market. You can come to the options market and say, okay, current stock price 130, what is the exact probability of Datadog finishing above 135 in the next 29 days? Well, you can make it up yourself, or you can just look at the mathematical algorithm of the Black-Scholes model and say it's 37%. There's a 37% likelihood of that strike price, 135, finishing in the money. And if there's a 37% likelihood of it finishing in the money, that means there is what would that be? 63? There's a 63% probability of it not finishing in the money, which means the market is telling me there's a 63% probability of that $3 will be worthless at expiration. So if you're the buyer and you hold all that contract to expiration, which based on what we just talked about, you want to do, but if you did, the options market is telling you have a 37% probable outcome of being successful. I don't like those odds, which means you want to hold a contract to expiration based on that. Does that make sense, everybody? Remember, we really don't buy options to exercise them. We buy options to sell them to somebody else after they go up in value. We buy options to trade them. The only time we really carry into expiration is typically failed zero DTE trades or trades you are allowing to get into expiration. And so once again, delta stands for rate of change. It tells us the exact financial figure that is going that you're going to capture per a $1 movement in the stock, and it tells you the exact mathematical probability of that strike price finishing in the money. Now, what delta also tells us is which strike price we should trade. Now, for new traders, typically what I suggest, until you start learning how to navigate all the Greeks, put the training wheels on, and typically what I suggest is just work at the money initially. And so what that typically means is any strike price around that 130 stock price. And so if you're dealing with the 130 stock price and you're looking to do any trade that you're looking to be in for 2 to 10 days, for example, you would want to deal with the 50 delta strike price. And so if I was making a trade on Amazon and I'm looking at all this, I'm going to say, okay, let's go. If I'm going to hold for a week, let's go that 29-day contract, all these different strike prices. I'm buying a call option because I expect Amazon to go up. Which strike price should we look at? Well, there's a lot of them here. What's my delta rule? My delta rule says, Matt, go to the closest strike price to at the money, 212.50. We got a 210. We got a 215. Either one of those, go to the 50 delta contract. The closest to 50 delta is the one you're going to trade. And so, guys, it's going to take a little bit of time, especially if you're really, really, really new to options, to kind of put this all together. But what I wanted to do today is just kind of do a little bit of a definitional. What are options? What are the option Greeks? How do they maneuver? And did that help you out today in just your base understanding of options? Got to get to know them all, Gabber. Got to get to know them all. No doubt about that. Oftentimes when I start teaching people about options, especially people that are new, it will feel a little bit overwhelming, a lot of definitions, a lot of things we haven't really thought about, right? Next week, guys, we'll probably do round 2 in options next week, and I'll take it a little bit further, and we'll do some application stuff next week in the lab. The week after that, we'll get back into some of our future stuff and technical systems, and we'll start working a little bit more on technical systems. But I thought might as well just do a little bit of an option conversation, because I know we've, sometimes when we're in our hangouts, we have a lot of different types of conversations. So I want to do one on the definitionals of options, get to know them a little bit. And with that said, guys, I got to run. I got to get to a meeting, but I had a lot of fun here today. And Aaron, I love covered calls. Covered calls are a primary system for me. I do covered calls on the long-term account, and I would love to talk more covered calls. I believe me, I've done a lot of them, Aaron. In fact, I built entire systems on covered calls before. Not before, like I manage an entire system on covered calls. So I would love to have more conversations on covered calls. And I know Gabber wants to have some conversations on naked puts and other cash flow systems as well. We will have those. I just wanted to have like a basic understanding, because I know there's a lot of new traders in BluSky that did not have any understanding of options. And so I just wanted to keep it to like definitions today, but we can certainly get into strategy and more complex conversations as well. By the way, futures have options too. All right, guys, I'm taking off. I got to run, but pleasure. If you need me for any reason, hit me up in Discord. Outside of that, I hope everybody has a wonderful, wonderful rest of your day. Later, team.